Hi everyone, it's Shane McGrath from Access One here. We're here today to talk to you about what's probably the least sexiest subject of wealth creation, and that's the basic stuff, all the background building blocks, which is arguably the most important stuff because if you don't get this stuff right, then you stand little chance of ending up where you want to be. So I'm here today to show you the facts. It's not a sales or investment recommendation presentation. So this is important to note as I'm not a financial planner, and as such the information provided is for education purposes. And your own personal circumstances haven't been taken into consideration. So I suggest before making any financial decisions, you consult your own professional advisors. Okay, with all that out of the way, let's go over what we'll be covering today. We'll be looking at the wealth mindset, how you're going to reach financial freedom, and where do you invest in the different type of asset classes. So there's one fundamental difference between people who are successful and people who are not. And it's not more money. It's not that they work harder. And it's not that they're lucky. Successful people know where they're going and they have a plan to get them there. Sure, money helps, but how many stories have you heard of people starting with nothing and working their way up to millions? It also does help if you work hard, but most successful people work the same, if not less than others. Luck, whatever that is, helps, but how many people win a fortune only to blow it in a remarkably short period of time? You see, it doesn't matter where you are now. You can be a success at whatever you want, as long as you have a purpose and a plan to get you there. Those who succeed set an end point for themselves early and work towards that from day one. If a person is working towards a predetermined goal and they know where they're going, then they're a success. Napoleon Hill defines success as the continual realization of a worthy ideal. And that's a pretty good definition because success truly is a journey and it's not a destination. You are a success if you are continually and constantly moving towards your predetermined goal. The greatest wise men in history all disagree about many things, but they all agreed on one thing. We become what we think about. Ralph Waldo Emerson, man is what he thinks about all day long. William James, the greatest discovery of my generation is that human beings can alter their lives by altering their attitudes of mind. Gandhi, Julius Caesar, Napoleon, Henry Ford, Albert Einstein, Mark Twain, Rockefeller, JFK, all used exactly the same formula to achieve their success. You need to start asking yourself what it is that you want. Ask yourself some questions like, what do I want my life to look like? How do I want my life to feel on a day-to-day basis? And what would I be doing 2 years from now, 10 years from now, 20 years from now? And how much money will I need to do the things that I want to do? The real question to ask yourself is, do you wish to be wealthy? If so, what are you prepared to do to get you there? We all know that money doesn't grow on trees, so it stands to reason that we need some sort of plan to create it. I'm sure everyone's heard the phrase, if you fail to plan, you plan to fail. And this phrase is so apt when talking about your finances. It's incredible to think how many people who have no plans for their retirement. You can be sure that all these people want to be rich, but they have never bothered to sit down and plan how they can make it happen. You can be rich, you can have a wonderful retirement at almost any age. But it won't happen by itself, and it's unlikely to happen without your direction, guidance and drive. Some people hate hearing all this wishy-washy psychological stuff, but they want to hear the real information. They don't realise how important these concepts are. In essence, the real information is virtually useless to these people unless they understand how it can be used in their lives. The key point I want to make here is that it's very hard to achieve anything without a plan. You wouldn't see a builder laying a slab unless he has the plans for the complete house. Your financial strategy is going to be the key to your long-term success. Let's spend some time now and examine where you are now and where you want to go. Okay, let's look at where you are now financially speaking. If you stopped work right now, and if you didn't change your current lifestyle in any way, how long could you live off your retirements and savings? Is it forever? Is it for the next 10 years, next 5 years, or maybe only until Friday? Let's look at the facts. Just to get by on $480 a week, that's $25,000 a year, you'll need $500,000 cash in a bank, or $500,000 in net assets returning you 5% per annum. So if you're like most of the Australian population, you may not have given your wealth plans as much attention as it deserves. So let's take a minute now and jot down the lifestyle that you want when you retire. List your goals and also how much money that you think that you're going to need to achieve them. Stop this video now if you have to, because this is a really important step as you'll see further on. Okay, so How much do you need to live the life of your dreams? Is it only $500 a week? Is it $2,000 a week? Maybe it's even $10,000 a week. So let's quickly do some calculations on these figures to determine your retirement needs. Here's a quick retirement calculator. Let's enter your income that you want to retire on, the money that you need to achieve your financial freedom. In this example, I'll use $104,000, which is in today's dollars. Now we need to adjust this figure for inflation, but I'll come back to that in just a minute. We then look at how many years you have until you retire. I'll use 15, and for you guys playing at home, you can enter a figure that you see yourself retiring in. Now, back to step 2, inflation. This will probably be an eye-opener for most of us, so let me explain inflation and how it can affect your money. Let me do a quick poll first. Assuming inflation of 3% per annum, what would you think $1,000 would be worth in 20 years' time? I'll give you a few seconds for you to guess, but let me give you a tip. Many of us severely underestimate the impact of inflation. Okay, who said it's still worth $1,000? Well, you'd be wrong. Who guessed $726? Close. The right answer is $570. Let me show you how I calculated that equation. What this table is showing, in 20 years, if you're receiving $1,000 a year income stream from someone or something, it will have the purchasing power of $570 in today's dollars in 20 years' time. So you can see that's a fairly significant impact, and I've used an average inflation rate of 3%. It's virtually halved your purchasing power over a 20-year term. The impact of this is huge, and it can't be ignored when planning for your retirement, especially when most people retire for more than 20 years. I hope that makes sense, as this would be a hard lesson to learn 20 years down the track. Okay, so getting back to step 2, adjust for inflation. Now, we have to adjust that $2,000 a week, or the $104,000 a year, for inflation. For this example, we'll assume an inflation rate of 3% per year. We accomplish this with the following formula. So we have today's dollars multiplied by the inflation rate as a decimal, plus 1, to the power of the number of years to your retirement. So the equation looks like this. Our $104,000 in today's dollars multiplied by 1.03 to the power of 15. And that gives us an inflation adjusted amount of $161,200. So I'll need $161,200 per year 15 years from now. So let's look at what level of lump sum that we're going to need to provide our income per week. Let's assume that we'll be able to conservatively achieve a return of 5% per annum. We would need to have a lump sum of $3.2 million just to give us an income of $161,200 per year, inflation adjusted. Now, to save that lump sum, you would need to put away $4,133 a week for 15 years. Once you play around with these figures, it might scare yourself into knowing how much you actually need. You'll quickly realise that the weekly amount required to save may be beyond your means, or even more than your annual household income. It may seem impossible based on what you can save now or what your employer is putting into super. You'll also realise the longer you leave things, the harder it gets. Just saving money into a bank account and relying on your super contributions is probably not enough for most people's desired retirement income. So how is it possible, and where can we accelerate the returns you need to grow your retirement nest egg? These days, it's possible to invest in just about anything. Sometimes some of the investments on offer are fantastic opportunities, and sometimes they're just plain rip-offs. It's important to be able to tell the difference. It's equally important to be able to work out which assets are going to be profitable for you and that they meet your risk and return objectives. Some people prefer high-risk ventures that are an all or nothing, whilst many others prefer a normal investment that is consistent and stable. The real trick is knowing yourself and know your investments. That's how money is made. So, what can you invest in? Shares, property, term deposits, plantations, super and gold. They're all some of your options. However, you should not invest in anything until you actually understand its potential risks and return. It's very easy to become overwhelmed with the investment options on offer. It seems there's a peddler on every street corner offering a fantastic new investment for you. So before you jump in and make any decisions, let's look at the basics. These categories are the basic three components of all sound investment strategies: the share market, the property market, and cash investments. So let's start and take a closer look at the different types. Cash investments include savings accounts, term deposits, cash management trusts, bank bills, government bonds. Cash investments are generally considered to be low risk. These investments are more of an income producing asset, not a growth asset. This is an important point to remember because it explains why you'll never get rich simply putting money away in a bank. Remember our little inflation example? Quite simply, you'll find that inflation outpaces you nearly every single time. These types of investments are great for guaranteed income, not for capital growth. The share market is one of the most obvious sources of investment. A share in a public company is just that. You share in the ownership of the company, although it may be a very small part of the company. The transformation in the Australian share market over recent decades has been truly amazing. Over 40% of all adult Australians own shares, either directly through actually owning shares or indirectly through a managed fund. In addition to buying shares themselves, every employee has a superannuation account, which is also very likely to have investments in the Australian share market. But most people are still very wary of shares and regard it to be a high-risk investment. The share market is not necessarily a high-risk investment. As with all other investments, it depends on what you invest in and how you do it. For example, there are quality companies that have strong trading records. These are usually blue chip companies that are classified lower risk, companies like banks and mining giants. Then there are companies that represent a medium level of risk. They may be medium-sized companies that have good growth potential but may not be as established as the blue chip companies. Then you have speculative shares that represent a high degree of risk, especially to new investors. These are typically shares in small companies that are about to make it or break it. The key thing to remember with share investments is the choice of shares can be arranged to suit your investment needs and risk profile. This choice and flexibility is one of the greatest things about share investments. Let's look at the property market. Property investment is still considered to be one of the safest investments to make. There's nothing safer than bricks and mortar, or so we're led to be believed. Property has for a long time been the primary investment choice for Australians and continues to be for many reasons. Property investment, like other types of investment, can fall into various categories, all of which have different levels of risk and returns. This point is a very important one, because most Australians seem to think that if you've invested in property, then your money is guaranteed. As with any investment, this is definitely not the case. There are four main categories for real estate worth mentioning at this stage. The first being the family home. Owning your own home is still an achievable dream in Australia, and for many, this is the single largest investment they'll ever make. When you buy the family home, you are not thinking of resale value, capital growth potential, and not thinking about how this asset can help your wealth creation plans. This is a shame because usually your home is the key asset that gets your whole investment program up and running. Then we have residential property investment. Owning rental properties has long been used as a wealth creation plan, and in today's environment it still can be an excellent way to build wealth. Did you know that most property investors sell their homes within 5 years because they're dissatisfied with the tenants or the property performance? These people don't realise that property works best as a long-term investment. Residential property can be high risk or low risk. It depends on the location of the property, the economic strengths of the local area, and of course how much you paid for it and how well it rents out. The good news is that many people make excellent money from property investments. These people are the ones who know and understand how the market operates. We'll spend a fair amount of time in later videos discussing property investment and giving you practical tips on how to maximise your potential returns. Commercial, industrial and retail property investments open up an entire new investment world. Generally speaking, they have businesses as their tenants, and they are larger and classed as a higher risk than residential, but they can pay a higher return. These types of investments are subject to different factors and require more knowledge, time and capital. Growth in these markets is subject to different factors also, and the right type of financing arrangements is of paramount importance, not for the faint-hearted or new to investing. And finally, property trusts. Property trusts are ideal for investors who don't wish to deal in property directly. Effectively what happens is investors' funds are pooled together to purchase a property portfolio, usually commercial, industrial and retail. The larger listed property trusts offer a lower risk because they're actively traded on the stock exchange and are therefore very liquid investments. As you can see, there's a property investment to suit just about every size budget and risk profile. Historical figures clearly show the steady growth experienced by real estate, and throughout these workshops, we intend to show you how to maximise the growth potential in your real estate purchases. We find it much more profitable to know the market better and anticipate growth areas to ensure that you have the maximum growth in the least possible time. So now we know what investments are out there, let's look at the performances of some of these. Having said that, what exactly do we mean by investment? Investment is the process of buying well-valued assets in the expectation that we will see an increase of value over time. Investing means to focus on quality assets that have good sound fundamentals. Investing is often considered to be long-term. The safest investment are long-term investments that are held for, say, at least 7 to 10 years or even more. These charts investigate the performance of various types of investments over the past 10 and 25 years, with the aim of providing you with a reasonable insight into how different investments have performed over the medium to long terms. The results are that residential property achieved the highest return of 10.1% per annum and 11.6% per annum respectively for the 10 and 25 year periods, while Australian shares returned 8.4 and 10.8% per annum over the same periods. While no surprise that cash had the lowest return of the three asset classes with 3.8 and 6.1% per annum, illustrating that while cash is a safer environment, the returns are not going to make you rich. This is why I have included the before and after tax results, as it shows cash would not outperform inflation on both 20 and 25 year periods. I should mention also that the gross returns are calculated before tax but after expenses, giving you a fair comparison on investment performance. Now, there's another very good reason why property outperforms other asset classes in terms of return on your money. It's called leverage. Using the bank's money instead of your own provides you with a far greater return on your money you actually invest. Banks will lend you up to 90 to 95% of the value of property to any person on a consistent average wage. However, banks may only lend up to 30 to 70% on blue chip type shares. It's best described with this table. On the left, this example shows us purchasing a $300,000 investment property, and on the right, a $300,000 share portfolio. The asset cost is the same, but with the power of leverage, we can borrow 90% of the value of the property, which enables us only to outlay $30,000 of our own money. By the way, this can be equity in another property that you own, so you don't even need to put your hands in your pocket. On the right, to purchase a share portfolio, we normally use a margin loan. And in this case, the banks will lend us 50% of the value of the shares. So that's $150,000 I need to come up with as a deposit. I've taken the growth rates from the previous example 10-year investment returns, and based on these returns, property grew to $330,000 and the share portfolio grew to $325,000. Not a massive difference in growth, but we only used $30,000 of our own money on the property, whereas we used $150,000 on shares to get a similar return. But our return on equity, or your money out of your pocket, is vastly different. Property returned 101%, while shares only 16.8%. This is a very powerful point, as you want to use other people's money, not your own, to invest and to build wealth. From our discussion so far, you must be familiar with the concept of property as a long-term investment. And when property is held over the long term, it's one of the best wealth creation tools. For starters, most of us are familiar with it. We have some form of experience with it, whether renting or owning. But property investment can be much, much more than just a comfortable place to live. It's an inflation-proof income-producing asset that can help fund our retirement. Careful and intelligent use of real estate can enable ordinary Australians to become millionaires. And despite the concept of property belonging to the rich, most Australian property investors earn an average wage. So the purpose of today's workshop was to give you an understanding of some of the building blocks that you need to know as an investor, to help you get on the track and to help you understand that if you're not doing anything now to plan towards your retirement, then maybe your lifestyle in retirement is not going to be what you thought. And of course, I hope I've fueled your thirst to learn more. Also, look out for more with our next workshops. And until then, I thank you and I look forward to chatting with you then.